Namaste. Classification of financial liabilities does not follow the same approach as we have followed in case of the financial asset. Financial liabilities are classified either at FETPL or at the amortized cost. So financial liabilities are classified at FETPL if they are held for trading purpose, or if financial liabilities are designated on initial recognition at FVTPL. We can designate financial liabilities at FVTPL if they remove the accounting mismatches or significantly reduce or eliminate a measurement for recognition inconsistency between the financial assets and financial liabilities. This topic we'll discuss separately. And in case if the financial assets or combination of financial assets and financial liabilities are managed and performance of that is measured at fair value and reported to key management personnel as defined in IND 24, that is related party disclosure. So we can designate these financial assets liabilities at FETPL. And in case the financial liability is containing one or more embedded derivative meeting certain conditions that we will discuss separately. Apart from these financial liabilities, all other financial liabilities we will measure at amortized cost. What is financial liability that is held for trading? So, as per IND 9, in addition to the derivatives, those derivatives are not accounted as hedging instruments. Held for trading includes, for example, there is an obligation to deliver financial asset borrowed by a short seller. For example, if a company X borrows a shares of Reliance from Y and sells them in the market, in this case, X had borrowed the shares from Y and have sold them in market, but it does not own the shares. So in that case, it will be called as a financial liability that is held for sale. Another example we can take where the financial liability is incurred with an intention to repurchase in near future. For example, if entity issued bonds, those are listed in market and entity buy back those bonds in near future based on the fair value change of the bonds. In that case, we will call it as a financial liability held for trading. Third example we can take of financial liability for which it is evident or a recent pattern of the entity of short selling those financial liabilities for making profit. So in this case, we will classify those financial liabilities as held for trading and we will account for these financial liability. Those are held for trading at FVTPL method. 109 gives an option to an entity to measure its financial assets and financial liability at FVTPL method if it has resulted in accounting mismatches. And this option is available at the time of initial recognition only. But how an entity and at what basis an entity will demonstrate that there will be an accounting mismatch in the transaction. So this total concept is based on the two principles. First, there is a perceived economic relationship between the financial asset and financial liability. It means that the financial asset and the financial liability both are affected by the same risk, and because of that risk, valuation of financial asset and financial liability will move in different directions. And the application of IND 109 will result in measurement and recognition of gain and loss at different method. For example, if a asset is measured at amortized cost and the related financial liability is measured at FVTPL, but they have the perceived economic relationship and that is affected by the same risk. In that case, there will be a valuation impact. One impact will go in PNL and other impact will go in OCI. So in that case, there will be an accounting mismatch. And at that case, Ind AS 109 provides us option to measure the FA and FL both at FVTPL. For example, in case of insurance contract, if the financial liability is measured based on the current available information as per Ind AS 9, but the respective financial asset is measured at FVT, OCI or amortized cost, in that case, the difference will arise and that will be called as accounting mismatch. Another example is if an entity has financial asset also or financial liability also, and they share the common risk, for example, interest, etc. And because of this risk, there is a change in value and that offset impact of financial assets and financial liability. In this case, however, out of this kitty, only some of the instruments are measured at FVTPL. So in this case, we have option to measure the financial assets and financial liability both at FVTPL.